Hey everyone, I'm John Carvello, president of Stone Oak Capital and Divestopedia. Thanks everyone for taking an hour out of your day to join us. We're here today talking about reps and warranties insurance. I'm super excited about this topic. Lots of people have been asking me about reps and warranty insurance, and so I thought I would get an expert to join us. And the expert that I have with us today is Dan Simnowitz. Dan is an executive vice president at Dual Transaction Solutions. Dan, thank you for joining us today.
Thanks, John. Very happy to be here.
Awesome. Hey, can you give us maybe a little bit of background on you, your firm, how you're involved with this topic of reps and warranty insurance?
Absolutely. So Dual, I'm an executive vice president. You said a Dual Transactional Risk, which is we've rebranded to Dual Transactional Solutions. We are a managing general agent in the transactional liability space. We underwrite reps and warranties insurance we're going to talk about today, contingent liability, and starting the next few months, we'll be also looking at tax insurance as well. So full service underwriter in the reps and warranty space.
Awesome. And you were a part of another panel that we did, and you just provided such an awesome overview of rep and warranty insurance that I wanted to get you back so I can pepper you with a whole bunch of questions around rep and warranty insurance. And I think that's going to be kind of the format for today. Is I'm just going to pepper you with a whole bunch of questions. Let me know if they're stupid questions. If they are, we'll move on to the next one. But if okay with you, that's kind of how we'll run today's workshop.
Terrific. There are no stupid questions, isn't that?
Awesome.
That's an expression, right?
Yeah. And then we'll try to do that for like half an hour, 40 minutes. And then at the end, I'm sure we're going to get a lot of questions from our audience. So, for everybody that has a question, please put it into the Q&A dialog box. I think we all know how to do that by now on Zoom. And we can, definitely get to those questions towards the end of the presentation. And before I also move on, I know that, there's going to be a lot of people that are going to be reaching out to you with questions. So I'm going to share your email address so everybody has it. And I'll continue to share that throughout, but I'm just sharing that in the chat box. So audience, let me know if you guys can see Dan's email address in there. Awesome. Everybody ready to go? Come on, give me a yes in the chat box here. Perfect. I got a few yeses going. Great. Okay, so here we go, Dan. I'm going to start peppering you with questions. So give me a high level overview of reps and warranty insurance. Maybe some of the key trends, benefits that you see for both buyers and sellers.
Yeah. So the key trends, so rep and warranty insurance, just to take you back a little bit, it's a product that's about 20 some odd years old. But really didn't take off in terms of usage by buyers. And it is also used by sellers, but much more frequently by buyers. And about 5 or 6 years ago, the product really took off as the underwriting became really streamlined so that we could fit our underwriting within the confines of kind of the deal flow, right? So we didn't want to be holding up the deal. So as rep and warranty insurance has gotten a bit more popular, been used, primarily it started as private equity buyers were the biggest users. They still are the biggest users of rep and warranty, but we've seen a lot of strategics in the last 3-4 years really adopt the product, and they haven't really had a choice. Its adoption rate is higher and higher over the last few years. So in 2021. We saw the busiest year, at least in the United States, ever for rep and warranty insurance. We had, just speaking from Dual's experience, we had, just over 5,000 submissions. That means we saw more than 5,000 potential deals during 2021, which was, double at least that we saw in 2020. 2020 was obviously a little bit of a different kind of a year, but even if you look back to 2019 pre-pandemic, it's still probably double, maybe a little less than double the amount we saw in 19. So the uptake on the product was tremendous. We had, it was a tremendous year for M&A in general, all over the world. And so, with the higher usage, we've got more underwriters in the market. We've got a lot of specialty brokers who are able to bring this product to us and help facilitate the transactions.
Yeah, for sure. And what would you say, are sellers requiring this on deals, or are buyers just trying to mitigate risk? What's kind of the Or is it just kind of like now that this tool is out there, people are exploring it more and definitely kind of implementing it more on some of their transactions?
So it's a mixed bag. I think sellers, especially for a competitive process where there's a more of an auction type process where you have a number of bidders, you are seeing sellers. It's essentially table stakes. Sellers are requiring the buyer to purchase rep and warranty insurance, and as we'll talk about later, rep and warranty purchasing the insurance reduces the amount of the holdback, or even eliminates the amount of the holdback that the seller might have for breaches of reps and warranties. So it is kind of a deal. It is kind of a requirement. I think buyers, though, as they've become more comfortable with the product, also prefer it, especially private equity buyers. They really prefer sort of the idea that you've got a creditworthy counterparty on the other end, an insurance company. Insurance companies have become very skilled in commercial and figuring out how to handle these claims. And so it's really it's a combination of both. That's, I think I think at least one broker in the United States has estimated that rep and warranty insurance was used on 50% of all private company deals, which is really a tremendous amount of usage. So it's definitely been adopted by the market.
Crazy, 50%. That's insane.
Yeah.
And you think that I mean, COVID probably accelerated all of this, right? Everybody trying to mitigate risk, maybe a little bit of restriction in terms of access to due diligence and stuff. It's just accelerated, do you think?
Well, COVID was kind of an interesting driver. I don't know that it increased the sort of adoption or the amount that this was purchased. I think, what happened with COVID was, at least this is sort of my take on it, and I've seen others with different takes, but 2020, you've got private equity firms and you've got corporates with a tremendous amount of cash just on hand, whether it's on your balance sheet, whether it's your fund. And when M&A took a pause in early 2000, February, March 2020, everyone was just sitting on a lot of cash. And I think folks didn't know how to value companies in the midst of the pandemic. There were some challenges around how do you do diligence? What's going to be the what's post-COVID world going to look like? And I think by September, October of last year, there was just a tremendous amount of 2020. Sorry, there's a tremendous amount of pent up COVID demand. And as deal makers became more comfortable with Zoom and with virtual meetings, and there were some, I think travel kind of resumed a little bit, September, October of 20. All of those, everybody who had deals in the pipeline and we're just waiting to see how they made it through COVID, once everybody kind of understood how to value a company and how to operate a company during COVID, I think you just saw a real takeoff in M&A. And I think the insurance, we were able to adapt anyway. I mean, for us as underwriters, we're not on site anyway. We're not doing site visits. We're not talking to the seller's management. We've sort of always been conducting our diligence in a virtual world. So we were able to adapt very quickly. And then 2021, there's just a lot of factors, but that was just a tremendous year for everyone in our industry.
Yeah, for sure. So I have a question here from Gary, and this is the exact question I was going to ask you right now. But what size of deals are rep and warranty insurance used on? Like, truthfully, I've never seen a transaction that I've worked on, and I work in kind of that lower middle market space, maybe sub $50 million, but I haven't seen a transaction that has used rep and warranty insurance. So a couple questions there. What size of transactions is kind of minimum size? And then, just selfishly, is Canada maybe a little late to adopting this? Or are you seeing transactions using rep and warranty insurance kind of across, not only the US, but Canada and globally?
Yeah, let's take it one at a time. So in terms of deal size, I think your deal size, what you can get, and I mean, we've, at Dual, we do focus a lot on, the lower to middle market. So we're looking at a lot of deals sub 50 million in enterprise value. So we've underwritten deals. I think I personally have underwritten deals as low as 9 million in enterprise value. So
okay, wow.
We've done a lot of small deals. The market, I think, has begun to recognize that there's value in small deals for a lot of it, especially as insurance companies create a portfolio of risk. You don't want to have too many large deals weighing down your balance sheet and it's good to mix in small deals. I think that's certainly a consideration. And there used to be, and I know we might talk about this later, but there used to be a I think there was a perception that perhaps that on a smaller deal, you didn't do as much diligence as you would have done on a larger deal. And that's kind of where Rep and Warranty Insurance started out, was deals sort of over 100 million in EV. But I think now we're definitely looking at a ton of deals, less than 50% of them, and 50 million enterprise value. And I know in our book, we probably did, it was probably 30% of our book was less than 50 million in enterprise value. So it's definitely viable option. Turning to Canada, I've had some experience in Canada and at other shops. We don't currently, although we'd like to be in Canada, we're not currently in Canada dual, but I do know from talking to a lot of our brokers that I wouldn't say, I'd say Canada might be a little behind, but there's good deal flow in Canada. I think there's a lot of opportunities. I think, a lot of the opportunities are sourced out of kind of the Ontario and then perhaps over in British Columbia. So maybe everywhere in between, it might be a little bit more difficult or not as widely used. But I do know that Canada is a lot of the numbers that you'll see put out by insurance brokers relating to Rep and Warranty actually just include the entire North American market. So most of the major brokers do have experts in Canada to help facilitate the placement of Rep and Warranty Insurance on Canadian deals.
Yeah. And then globally, I know a lot of our audience are in other parts of the world. Are you seeing the uptick of Rep and Warranty Insurance in Europe, in other parts of Asia?
Absolutely. Yeah. There's an uptick in all parts of the world. I think Rep and Warranty Insurance, they call it warranty and indemnity insurance in Europe and actually outside the United States. I think the product actually is more entrenched in those areas outside the United States, outside of North America, than it is in North America. It's been more widely used over a longer period of time. So frankly, it was a great year in North America. It was a great year all over the world for warranty insurance.
I'm just going to share your email again here with everybody in our chat box, just so they can connect with you. And I'm sure there's going to be lots of people that are going to have questions outside of this information session directly for you. So let's talk about costs. What are typical costs of policies? How are premiums determined? What are minimum premium amounts, underwriting fees? Let's just talk about the cost of actually obtaining insurance.
Absolutely. So, the cost, well, let's say this pricing is very fluid for Rep and Warranty Insurance. And I think the pricing depends on the class of business of the target company. So if the target company is a financial, so there are some classes of business that are historically a little more challenging than others. So financial institutions, so say a registered investment advisor in the United States, or a life sciences company, or healthcare, those will usually garner a higher amount of premium than a sort of run-of-the-mill kind of distributor or manufacturer. And then even within, so that's kind of the way we look at risk. I think that some of those are more regulatory. I think as a general matter, the more, and this is really certainly an issue in the United States, the more regulatory scrutiny there is on a particular company, there's likely to be a little higher premium associated with those deals. But pricing is really, it's very interesting in our space. I think everyone has a different philosophy about how you price deals, what's an adequate price for a deal. But generally speaking, right now, I think we're seeing pricing kind of what we price on a rate online. It's rate per $1 million. So 4 to 5% per $1 million. So for instance, if you had a $10 million limit of liability, it would be somewhere between $400,000 and $500,000 for a particular for the premium itself. And then aside from the premium, also due to the insurance, we typically hire outside lawyers and sometimes accountants to assist us with our evaluation of the buyer's diligence. And there's what we call due diligence fees. And those can range from, 45,000, some charge 50. And so that's kind of the costs that are associated, especially, in the United States with purchasing a Rep and Warranty policy.
So those would be independent of other, like the actual company that's the acquirer. their due diligence
Absolutely.
process. Okay.
So all of the transaction type expenses that you have, if you're a buyer, your outside counsel, your financial advisors, any other third parties that you might bring in to assist you with your diligence, that's on your watch. And truthfully, the rep and warranty costs typically, you see them split between buyer and seller. It all depends sort of on the dynamics of the between the parties, right? So to the extent that the buyer might negotiate a split of the fees there, or the buyer might bear all the fees, or sometimes we see the seller take all the expenses. It just depends.
The expenses of the actual premium, or just the expenses of the, okay.
Yeah,
Really?
sometimes they're really just lumped together. In a lot of times you see them lumped together, the premium plus the due diligence fees. Usually that's split, or a lot of times it's split. Sometimes it's just borne by one party or the other.
So do the sellers feel like they're like doubling up on this work? Now they have to do due diligence for like two independent parties, the insurer and then also the buyer, or is it kind of like, kind of a combined front when you go on doing due diligence?
Yeah, so it's an interesting question. So it's just a step back for a minute. Most of the, more than 90% of the policies are purchased by the buyer, right? So the buyer is what we call the insured under the policy. The buyer will make the claim. So there are, historically used to be that the seller would buy the policy it could be that the seller bought the policy to backstop an escrow claim made by the buyer, but that's not the norm. Now the norm is that the buyer purchases the policy. So the seller's involvement in purchasing, the rep and warranty purchasing process is relatively limited. We don't typically, when we're doing a buy side policy as an underwriter, we don't talk to the sellers. Buyer might request, we might have some questions for the buyer in which the buyer has to go back to the seller and ask for more information. So the seller would be involved in that. Seller obviously knows that we're buying the policy. Sometimes they'll ask to take a look at the policy before the deal closes, but seller's involvement in what we're doing is relatively limited. So it's not an additional burden for the seller.
Yeah. Okay. Just a clarification. I have somebody asking, would rep and warranty insurance 4 to 5% be based on the entire enterprise value only a portion of the deal value typically? So it's actually 4 to 5% is the coverage limit, right?
Is the coverage limit? Yeah. So let's just take a typical scenario, $100 million enterprise value, typical purchasing pattern for a buyer is to purchase 10% of the enterprise value as your limit of liability. That kind of comported to what the escrow might have been. So you might have held back $10 million if you're the seller. So now the seller doesn't really have to hold back much or anything. Buyer purchases a $10 million policy. The rate per million would be 4% or 5%. So the policy would cost you just the premium, $400,000 to $500,000. And again, that's fluid. These are just estimates, but that's kind of, what we're seeing right now.
Yeah. And then with the kind of due diligence fees and the underwriting fees on top of that, right?
Yeah. So you're throwing, it's one fee and you could be throwing $45,000 on top of that.
Okay. Yeah, no, that's great. And then, so let's talk about we talked about policy coverage limits. Let's talk about deductibles. So is there typically a minimum deductible of the purchase price or enterprise value? Is there sharing of the deductible amounts between buyers and sellers? Like what would typically be a deductible on these policies?
So usually the deductible is 1% of the enterprise value. So again, to take you back to your $100 million enterprise value deal, it would be a 1% deductible. So $1 million deductible. And I'd say, there are two options. Really three options you can have for the deductible, but I'll give you we'll start with the least common, then we'll move to the most common. Sometimes the seller, we've had situations where the seller bears the entire deductible. So $1 million. So they're putting $1 million in escrow. So in our example, they put a 1% in escrow, or $1 million in our example. That's not as common. Probably right now, the most common is a split of the deductible. So in our example, going back to the $1 million deductible, the seller would put $500,000 in escrow for usually a period of 12 months. And at the end of 12 months, that escrow would be released, assuming there are no claims or what have you. We are seeing a trend. I'm not I'm not sure really whether it's a trend or not, because it varies year to year, but there are, always a good amount of deals where the seller leaves nothing in escrow, where the seller really walks away. Really almost a complete walk away, other than perhaps what liability that they have for fraud, and then any sort of other specified matters that have been negotiated between buyer and seller, and perhaps working capital adjustment.
And that's one of the biggest benefits of rep and warranty insurance, isn't it? The reduction of the escrow to the seller.
That is, if I were the seller, that would be, that's the number one benefit. Instead of putting $10 million in escrow, $10 million in escrow for a year, you're essentially putting 500,000. So if you think about why this is so attractive to a private equity firm, or why private equity firms push it on the sell side, they obviously don't want to tie up $10 million ever. Right.
Yeah.
So they want to return the money as quickly as they can to their LPs. So having to only tie up 500,000 or $0, or, some small amount of dollars is kind of the ideal scenario. Now, not every buyer wants the seller to have a complete walk away like that. And, usually there is, when we look at these deals, a deal without any seller indemnity is usually priced slightly higher than a deal that has some seller indemnity, because at some point the seller really doesn't have a lot of skin in the game. He's not really standing behind those reps. We have some concerns about whether they're standing behind them or not.
How do other kind of stakeholders view that, like financial institutions that are backing the deal, to have a seller that has no skin in the game? Like, do they have any sort of reservations around that?
That's a good question. I do know that I don't know that that's the most popular course of action for anyone, except for the seller. Normally, in a lot of situations, our policy will be assigned as collateral to the new lender for the seller. So that does happen some. So the seller has to make sure that the lender, the buyer's lender, has some recourse. But you don't get. I think in these situations, we don't hear a lot about what the lender thinks. We always ask what lenders are. There's lenders on most of these deals, and we ask what type of due diligence they're performing, and if they've found anything, because their due diligence, they look around valuation and things of that nature. And viability of business moving forward. But they're also looking at historical liabilities as well, in the same way that we are. And so we always ask if the lender has spotted any issues. And I don't know whether, in the background, whether the lender has any objections to a particular structure of how the insurance is being structured.
Yeah, no, that's fair. And then kind of going back to that reduction of escrow, I guess in a heated M&A market, that probably helps win deals too, right? Where you can come to the table and say, hey, there are no escrows on this deal. So I'm sure that's probably a driver of kind of the uptake on R&W insurance.
Absolutely. And I think that's one of the reasons why strategics have had to adopt the product. So corporate buyers historically were not the main users, as we discussed earlier, of rep and warranty insurance, but they've had to adjust as they're competing with others who are willing to buy the product. They've had to adjust and also to include rep and warranty as a deal term, in the LOI.
Okay, yeah, great to know for all the corporate buyers. I know there are a few on this call here, so something that you definitely need to feel comfortable with, and reach out to Dan if you have any more specific questions around that in executing your acquisition strategy. So let's talk about limits and coverage, exclusion of coverage. So over the last kind of year, I'm sure things like force majeure or other types of kind of risk mitigation representations within an agreement have come to bear. So how do you guys deal? Talk to us about limits and exclusion of coverage.
Yeah, so limits, as we said, limits are typically 10% of the enterprise value. Could be more. Sometimes some buyers want to purchase more than 10%, maybe 20%. So back to our $100 million example, you might want to purchase 20 million in coverage. Some buyers are cost sensitive and perhaps want to purchase or feel very comfortable with the company they're buying, and might purchase less than 10%, but the average is around 10%. So that's kind of your limits. We talked about deductibles. In terms of coverage, there are a couple of exclusions that are standard on every insurance policy, and then we can talk about some of the exclusions that might be specific to a particular deal. So with respect to standard exclusions, one would be the kind of actual knowledge of the deal team, so of the buyer's deal team. So, whereas in a lot of US jurisdictions, especially Delaware, you can sort of sandbag, you might know about something and hold it and then just bring a claim against the escrow against the seller after closing. You really can't do that to an insurance company. So matters that are known to the buyer or actual knowledge of the buyer are excluded. So that's kind of your first main exclusion. Then you've got other exclusions that have historically.
Sorry to cut you off there.
Yeah.
Maybe just give us an example so we have a good sense.
Yeah, sure. So
something you've seen.
Yeah, sure. So if you knew about a particular, for some reason you knew about a particular customer, the buyer knew pre-closing about a particular customer that might be unhappy or that could be leaving. This is just, an example. And, it wasn't disclosed on the schedules, the disclosure schedules. Buyer, you didn't really disclose to seller that you knew about it. You're welcome to hold that and bring a claim against the seller, assuming you can under the agreement. But that's not something that we really, as insurance companies, we're not there to take those types of claims. There are a lot of known matters between buyer and seller where they allocate risk amongst each other. But if the buyer knows something and hasn't exactly communicated to the seller, they know it. There are some jurisdictions in which you can just bring a claim against the seller. But for us, if you knew about it, it's an actual knowledge exclusion. You can't bring a claim against us.
Okay.
So that's kind of an actual knowledge exclusion. And then there are some couple of other exclusions that are fairly standard. One is asbestos. That's killed the insurance industry over many years. Not going to find coverage for that under this policy, under this type of policy. Transfer pricing and NOLs and availability of net operating losses. Those are two issues that are probably best off for a standalone tax policy or to be allocated amongst buyer and seller. Those are complicated issues that are not really covered under a rep and warranty policy. So those are your kind of standard exclusions, and then also underfunding of a pension, of a defined benefit pension plan, or with withdrawal liability. Those are, again, not exposures that insurance companies are seeking to pick up. So those are your standard exclusions. And then as we go through our underwriting process, we have deal specific exclusions. So those that come out in diligence. So the deal specific exclusions are those that are sort of known to buyer. And so for instance, in my material customer, if buyer communicated to us that they knew about a customer that might leave, and that would be a breach of of a particular representation, we would exclude that under our policy. It's a known liability. So known material liabilities are excluded under our policy, whatever they are. So, a very common exclusion in the United States is failure to pay sales tax. A lot of technology companies just don't seem to not pay taxes in all the jurisdictions in which they need to pay them. Buyer usually does diligence, figures out where they should be paying them, but have not been paying them, and that's usually an exclusion under our policy. We're not going to pick up what you know about. It's only our policy is designed for sort of unknown liabilities, unknown to the buyer.
Okay.
So that's kind of how we structure the process. If you know of a liability as a buyer, you can either decide it's going to be excluded under our policy, but you can decide, do I want to shift that risk to the seller? Do I want to bring it to the seller's attention and have the seller, establish some sort of risk, shift the risk to the seller, create an escrow around that issue? Or you could just decide, I'm going to ride it out and see what happens.
Yeah, roll the dice and see if it comes to fruition. And then coverage terms, how long are typical policies for? Are they like 3 years, 5 years, 10 years? What's a typical policy coverage term?
So we have two coverage terms really built in within our policy. So there's a 6-year policy term for certain representations. So for tax representations, and that just goes to the statute of limitations under U.S. law for tax. So 6 years for tax, and also fundamental type representation. So authority to convey shares, capitalization, things of that nature. You get 6 years for those. And then you get 3 years for all other representation. So financial statements, material contracts, and other intellectual property and environmental things of that nature. So it's really a sort of bifurcated policy period.
Yeah. And do you find these are pretty standard across like different insurers that are,
Yes. Yeah. I think that's a market standard approach. I mean, I think there's always a possibility if you want to make a particular representation, bring it out from 3 years to 6 years. Sometimes we see that with intellectual property or environmental. Usually we might agree to that for an additional premium. So it might cost you, $20,000-$30,000 extra to extend the policy period from 3 to 6 years for those non-fundamental or tax reps. So that's certainly a possibility, but the standard is 3 years for general, what we call general reps, and 6 years for fundamental and taxes.
okay.
And that's the same in Canada too, by the way. That's similar to the Canadian market.
Yeah, for sure. And probably other parts of the world too. I'm sure that I think the UK was kind of like the leader in starting this, and then it's developed, but definitely I'm sure has kind of global metrics and parameters that are market, like you said.
Absolutely.
Let's talk about the process for obtaining rep and warranty insurance. So who starts the process? Is it the buyer or the seller? When do you initiate the conversation? Is it typically before the LOI? And then have a few more other questions around that, but let's start there.
Absolutely. So the process typically starts, so it comes to, so all deals, all opportunities come to us through a broker. So in the United States, you can't, as a buyer of a company, as an acquirer, you really can't go direct to an insurance company. So you have to contact. So put a plug in for all the brokers. You have to contact your local broker, and then brokers bring these opportunities. Their submissions to market to us, and the submission typically consists of a SIM or a management presentation, financials for the target company, and then also a draft of the purchase agreement. Sometimes we get a little more depending on the type of company. So that all comes to us from the broker. I think the process, because it's buyer driven and the buyer's purchasing the insurance policy, the process is kind of driven by the buyer and its counsel, the buyer's counsel, and then they sort of reach out to the broker. Broker gets all the information that they need. They understand, what the company is that's being sold, and then they figure out, who would be the right markets or insurance markets to underwrite the deal, and then they send it out to us. And at that point, then we will then provide sort of a term sheet for a proposal for insurance.
So the broker is going to multiple different insurance companies and getting different quotes on what the policy cost might be. And
absolutely. Yep. So you get we call it a non-binding indication letter. It's really just a term sheet. And what's typically in our term sheet are proposed pricing. So that's premium. And then there's also the deductible. So we call it a retention, potential exclusions other than what we consider to be standard. So there are sometimes we look at a particular target company and we decide, for whatever reason, we don't want to pick up, one area in which some carriers or insurance companies like to limit coverage. It's wage and hour in the United States. Employment matters. Sometimes you see limitations around that. Cybersecurity, cyber, environmental. And so you might see some deal specific exclusions, and then we also include areas what we call heightened risk. So these are the areas where we look at the deal and we think we just want to know more about your diligence, what you've done in those particular areas based on the characteristics of the target company.
I'm actually surprised that you get involved that late when there's, after LOI, when there's a purchase agreement. I mean, the brokers must have a pretty good idea of what the, insurance policies are going to look like. And then they just take them to you to get this indication of kind of interest or term sheet.
Yeah, it's interesting. We do get, so we don't begin our underwriting in the normal course until the buyer is under LOI. Okay, so normally we don't engage counsel, we don't start the process, but we do often see information on transactions for buyers that are bidding on a particular target company. And it really just depends. Some buyers really want to know, well, what's the insurance market going to offer me here? Some are willing to take an indication from a broker because the broker knows the market and say, well, this is likely to be the range of your pricing. These are going to be the terms, and these are the markets or insurance companies or MGUs that I think would write it. It really just depends on whether the buyer wants the broker to go out to market before they've obtained exclusivity.
Okay. So let's kind of move to the next step now. So now I guess they've signed your term sheet. Let's talk about, the diligence that you guys will do on it. And one area that I really want to talk about is do you think Rep and Warranty Insurance has kind of reduced the level of diligence that buyers are doing on transactions, or is there, kind of a forced requirement from you guys to say, no, you need to kind of maintain this level of diligence and this level of information kind of review for us to implement this policy here?
Great question. So I don't think it's reduced the level of diligence. If anything, I think it's increased the level of diligence, or at least held it to a certain standard, right? Because, a lot of what we are doing is underwriting, is kind of underwriting to the diligence you've performed, you as the buyer, and has performed. So if there's a gap in your diligence, and that gap is an area in which, in our opinion, or we think that there could be a material liability, that's likely to lead to an exclusion as well. So it's not just what it's what you haven't looked into that, based on the particular, class of business or the company and its relationships, could lead to a liability. So I don't think that the diligence has reduced. I think there's always kind of this is a tension when you get to smaller deals, and this is less so, and I think we talked about this earlier, less so today than there was 3 or 4 years ago. I think there's an understanding from the buyer that they're going to have to engage third parties to perform some of the diligence on a smaller deal. So what we usually look for in the normal course is a written legal report, covering general corporate matters, employment, benefits, intellectual property, things like that, depending on the type of business. And we'll also look for, a quality of earnings report from a third-party financial advisor, and then also a report from a tax advisor as well. So those are kind of the minimums of what most insurance companies will look for. And again, some deals you might not, some deals, it just depends on the deal, but for the most part, that's what we're looking for. If you've got a heavy manufacturer or something with a significant environmental footprint, we'll look for a phase 1 or the equivalent in the particular jurisdiction. And depending on the type of target, if it's a technology target, we might look for some cybersecurity due diligence as well.
Okay.
So that those are the types of things we're looking for. But I think that now that everybody, market and brokers, everyone understands what we're looking for, I think we have a far fewer conversations about the level of diligence being performed. I think that's actually been a pleasant surprise over the last 2 years.
Yeah, I could probably see that on smaller deals where, maybe guys do a lot of their own due diligence and outsource just, what's really necessary that they might not have the expertise in-house to do. I could see some pushback on that.
Yeah, well, I'll say this: strategics were always the area in which we had some issues, or at least traditionally was an area where there was, we're doing, strategics. You might have a really mature financial function, an accounting function if you're a public company or you're a large private company. But what we've figured out over the last couple of years is, once these strategics have learned how to use the insurance and what we're looking for, I think we can work well with their internal resources. It's not a matter of necessarily, it might take a little more work if you're not going to put together a nice package of written reports. That makes my life much easier. But if you've done the work, and we usually have an underwriting call to discuss the work you've done, I think you can still get to the same place. It just might take you a little longer. You might have to allot a little more time for underwriting, and then also, understand that if you didn't look into something, you might not get coverage for that.
Yeah. And do you have a menu of advisors that you'll use, or can, the buyer kind of select the advisor that they want to work with?
We're comfortable with, usually we know when a deal comes to market from a broker, we'll know who the buyer's advisors are. That's one of the things now that brokers have gotten, very, very used to, is providing us, who's the buyer's counsel, who's performing the QOV and the tax report. Those are the key things that we look at, because frankly, the quality of those firms makes a difference for us. in terms of how the diligence that those types of firms perform. So we usually know, we never dictate who they should use, but it does factor into the decision of how I'm looking at an account.
Yeah. And then last question on kind of the due diligence side and kind of a hot topic right now, but ESG, how do you get your head wrapped around ESG? It's a lot of it, I guess, is more qualitative than quantitative. Are you looking for ESG reporting, due diligence? What kind of requirements are you needing around ESG?
So we don't have any specific requirements around ESG, but what we do see are a lot of buyers, bringing in third parties to sort of look at to look at ESG and provide us with, and usually they provide us with reports around ESG. And I look at ESG as kind of a framework for risk management. If you're managing those areas well, then you might as a buyer, I feel good that you've brought in someone to look at ESG issues. Those are really important issues. And if the company scores well on those in that report, I feel better about the company overall. I think that kind of helps my evaluation of the company, but it's not necessary. And it's not, our focus is on the representations and warranties, and while an ESG does touch on the reps and warranties that a seller does make, it's not they're kind of, like you said, it's a little more qualitative. It's sort of more holistic. How does this company function, and how does it fit within sort of an ESG framework?
Yeah, for sure. Okay, we got a few more things to cover before we get to questions. Yeah. So let's talk about the actual insurance policy. So how standard are these policies? And how much room is there for negotiation? So let's start with that.
Sure. So the policies, like I said, you have standard exclusions, and every insurer or managing general agent has a different policy. But to be honest with you, the policies have gotten a little more standardized over the years. There are certain terms that are going to be common to everyone's policy. There is some negotiation around the margins to standard terms in the policy. And I'll give you an example of a standard term is how long you have to report a claim after you learn of one. So that might be something that's important, or how long an insurance company has to pay a claim after they've determined that the claim is covered. So could be some negotiation around that. But as everyone in the market, we have a lot of repeat players in the market. So the negotiation of the policy is really around, it's two parties. It's with the buyer's counsel, and then also with the insurance broker. And we're working with the same or similar, we're doing, there are firms that are the most sort of active firms in the M&A space are doing hundreds of deals a year. So we're going to have have negotiated a policy with that firm. So there isn't a lot of sort of back and forth on standard terms. Most of the negotiation is around exclusions and what those exclusions are going to look like, how they're worded, whether they're sort of narrowly tailored to the specific risk that we've identified.
Okay, awesome. And then you kind of touched on this, but the process for claims, what are typical reasons for denial by an insurer on a claim? And then follow on question to that, just the mechanism for dispute resolution.
Yeah, sure. So denial of a claim, I think the most typical reason for denial of a claim would be that it's not covered. It's their number one, our policy, there has to be a breach under the acquisition agreement. So if there's a breach, so perhaps the particular circumstances that are the claim notice that we saw, we determined that there actually was no breach. That's one particular area where we see, a claim denial. Another area would be that, yes, there is a breach, but it's excluded under our policy. But, the frequency of claims, I think as everyone has gotten a little bit more, as buyers have gotten more comfortable about how to use, what the policy covers, we see more claim notices. But, a lot of the claims that we see, they come in, we get information on the claim, and then normally, a claims handler on our side or insurance company side will ask for further information about, to try to establish whether there has been a breach and things of that nature. And resolving a dispute between insurance company and the buyer coverage. So we hope that there never is a dispute, but to the extent there is, normally that dispute resolution mechanisms are laid out in the policy. So a lot of buyers would prefer to have, arbitration or mediation, really arbitration be the sole recourse to determine disputes because it's private. Sometimes if the policy doesn't address dispute resolution, which it doesn't have to, you can buyer or insurance company are free to bring the claim in court. But that's very, very rare.
Just backing up on claims, what are the most typical claims that you see under these policies? Maybe give us
so
top 3 or 5.
Absolutely. So I think financial statements is always an area in which everyone sees claims. So inaccuracy in your, you see problems with your revenue recognition, or we see sometimes issues with inventory and the sufficiency of the reserve. Just those are the most common. That's the most common area in which you see a claim. And then the other area.
So what would the actual claim be? So let's kind of walk through maybe if you have a specific example there.
Sure. You have a bunch of inventory that's obsolete. You haven't done an inventory count, for instance, and you've just got a lot of inventory that's laying around. Nobody knew about it. Reserve is not sufficient to cover the obsolete inventory. Your financial statements don't accurately reflect that. That's one.
So the claim amount is the amount of the obsolete inventory that's there that wasn't disclosed.
Could be, yeah. Could be. We've seen claims where there's, sometimes it's borderline fraud where buyer has been billing, where the company has been billing its customer for units that they never purchased. So financial statements are inflated. Clearly, there's an inaccuracy. We see so that's financial statements. We see claims around material customers. So cancellation of a contract, the contract was canceled prior to closing, or you knew that a customer was going to leave, but you never disclosed it. That's another area. Intellectual property is another area of claims. Tax is an area where we see claims as well. So those are and tax, it's going back to what we said before, tax compliance, especially on smaller companies. And this is, we understand that it's to be expected. They don't have mature, especially on smaller companies, mature tax functions. They don't always pay taxes where they should. They don't always withhold the taxes that they should. And so we see claims there as well.
Okay. Let's talk about seller liability. I got my list here. So seller liability and indemnity. When will the seller retain some of the liability? So let's go.
So it's like we talked about before in a rep and warranty situation, the seller can retain half the, one half of the liability for the escrow. So if it's $1 million escrow, if it's $1 million retention, the seller might put $500,000 in escrow, and normally that escrow is held for 12 months. That's the typical. That's the normal course in the United States. So they could have liability for that 500,000. If there's a working capital adjustment, post closing, they probably have liability for that. And then the other main area that we look at is fraud. We always in our the entire market, insurance market does, but we require the buyer to preserve its right to go to sue the seller or to bring a claim against the seller for fraud. And, there's a mechanism called subrogation. If things are really bad, we would step into the buyer's shoes and essentially bring that buyer's fraud claim against the seller. So that's kind of the main area of exposure really at the end of the day is fraud. And you see sellers trying to trim away at that by, narrowing the definition of what actually is fraud in the purchase agreement.
Okay. Is there indemnity around kind of over policy limits? So if you had a policy that had coverage of $10 million and there's a liability there for 20?
Yeah, there could be. It just depends on how the acquisition agreement is structured. I've seen deals where buyer wanted extra protection for certain reps. I've seen this around government contracts in the United States. So we have a $10 million policy and they decided they really wanted an additional indemnity from the seller over and above the $10 million in our policy. So sometimes you see it doesn't necessarily mean it's backed by an escrow, but you could be liable for it. So you do see that sometimes, but that's not the normal course. And the other area where you see sellers retain some liabilities are matters that are shifted to the seller. So if we have a known litigation hanging out there, And that, we're not going to cover an ongoing litigation, but perhaps the buyer the buyer's going to assume that litigation post closing. They might establish an indemnity with the seller to cover the costs arising out of that litigation.
Okay. And just doing some research for our conversation, I came across, a term, no seller indemnity structures. What does that mean, and how does that work?
Yeah, so that's what we talked about, where the seller has no liability for any part of the retention.
Okay.
So that's the buyer assuming the entire retention. Really, in those deals, it's as clean. You really, beyond fraud, you have no liability.
Yeah, and you're seeing a trend. Is there a trend going in that direction, or?
Yeah, every year I think there's a trend going in that direction. I think maybe this year it was up. The amount of no seller indemnity deals were up from last year. But I think that probably I don't think there's a trend in one way or the other. It certainly is a good chunk of the market, and it has been a good chunk of the market for years. But I do think there still are a fair amount of seller indemnity, deals where the seller is on the hook for at least a part of the retention.
Yeah, for sure. Okay, I do want to get to a bunch of questions, but just the last thing that I want to talk about is just other types of insurance. So right at the onset, you talked about like tax liability, contingent liability. Are these different, and if they are, how are they different?
Sure. So tax liability is really it's a policy specific to known tax risks, so that it's outside. So while a rep and warranty policy will cover sort of general tax representations, if you have a more complex or specific, sometimes known tax issue that you want to insure against, and sometimes this comes up in the context of a deal where you have, in the U.S., one area where you see a lot of issues is an S corporation. I won't get into the specifics of the S corporation, but there are, sometimes issues around whether an S corp is valid. If it might get to a point where we're not going to cover the S corp. We know there's even though there is an issue, that's a good area for a tax, where you get a sort of an opinion from a legal opinion or an opinion from a tax advisor, where they believe that it's more likely than not that it would survive an audit, and then you can insure against that particular issue. So that could be kind of a deal specific item for tax, where it's not going to fit within a rep and warranty policy. The other type of policy you see out there are contingent liability policies, and this is much less frequent. You see this in the area of a lot of times in the area of litigation. So if you have a known litigation, again, this can come out of a deal circumstance. If you have a lawsuit that the buyer, it's deal point, buyer doesn't want to assume liability for it, seller doesn't want to assume liability for it, but the buyer does believe that it is defensible and it doesn't have a lot of merit, you might get an insurer to assume that risk. It's a much higher premium. It's obviously much riskier, but that's another area in which you can see contingent liabilities. You can see them for things like successor liability in the United States. You can insure against that. So there are areas in which contingent liability, these are really just for known matters, and so it gets a higher premium.
Okay. And then that seller tax or that sales tax issue that you talked about for some tech companies, would that could you get a policy under the tax liability kind of product that you talked about?
Not really, because there's not a whole lot. There's not a whole lot of data. There's not a whole lot of. I mean, that it's really just, it's almost like an audit detection risk, because that once you're audited, you're likely to have to pay those costs. Okay. You just have to pay them. So while part of tax liability insurance is kind of an audit detection risk, there also is like, well, if in tax liability, if I am audited, I have a real defensible claim here that I took the right tax position in an uncertain circumstance. For sales taxes, not going to really be able to solve that. You're just going to have to pay.
Yeah. Okay. Awesome. So I want to get to a lot of questions here that we have. This is from my friend, Greg. So you are insuring unaudited financial statements, or would you require that, a firm gets kind of audited financial statements? And is there a pricing difference between where you get the audit from?
No. There's two parts to that. So number one, we don't require audited financials, but that's not the position of every underwriter. So okay. I think depending on the type of business or the size of the business, we'd like to see an audit. And sometimes we look at it. I don't think we have a hard revenue threshold, but Generally speaking, if a company gets too large, we would have expected somebody to come in there and take a look at the books. But no, we don't require audited financials, and a lot of markets don't. I don't know that an audit always is picking up everything. I think, an audit's great. It's having a second set of eyes, but it's not always kind of doesn't mean you're not going to, doesn't mean your financial statements are totally are necessarily in good shape. So no audit is fine. For certain types of businesses, there really isn't, I wouldn't say that there's sort of an additional premium associated with not having an audit. Some businesses are very simple. Some small businesses, I wouldn't expect a $50 million business to have an audit. It just, if you're a distributor, I mean, you're buying goods and then selling them. It's not particularly complicated. Software businesses is not a very complicated method of revenue recognition. So I don't know that, an audit is always necessary for that.
Okay. And then you touched on just even if it's a review engagement, do you kind of look at that? If it's like, Joe Blow local accounting firm versus PwC, you'll look at that?
Yeah. So if I'm looking at an auditor, if it's Bernie Madoff's auditor, not going to be, doesn't really mean a whole lot. But if it's,
who was Bernie Madoff's auditor? They might have been, that might have been a big firm. So
actually, what? So I think if it's an auditor, a Big Four type of auditor, or even one of these sort of regional type auditors in the United States, like RSM or BDO, we look favorably on that. But really, it's the quality. You can look at the audit, even if it's by a firm you never heard of, and you can look at the notes and you can see the quality of the audit that was performed.
Yeah. Okay. This is a great question. So are you seeing a rep and warranty insurance in minority equity transactions?
Yeah, we are. It's much more popular. So typically the way that's structured, if you're purchasing a minority stake, in a business, we will insure as a percentage of your investment amount. So if you're purchasing, let's go back to the $100 million enterprise value. If you're purchasing 40 million, so 40% of that business, we would sort of look at, for our purposes, the retention would be based on your investment amount, your $40 million. You might buy a $4 million policy, but we're only going to cover 40%, if that's what you're going to own post-closing, 40% of your losses. So it's kind of a prorated approach.
Yeah, and that's actually quite common I guess it would be
much more common.
Lots of private equity firms that are looking at transactions.
Much more common than it used to be. Yeah, we saw quite a few of those last year.
Okay. For the deductibles, does it have to be a basket of claims that kind of reaches to the bottom threshold of the deductible amount, or is it just one claim? Like each claim
could be either. Yeah, we don't. So it's an aggregate amount of your losses, right? So if it's one claim that gets you to $1 million, that's fine. If it's 10 claims that gets you to $1 million, that's also fine. It's not. You see a lot of different structures of baskets, tipping baskets, and things of that nature in acquisition agreements, but we're really just looking at the aggregate of your losses.
Okay. How do pro and anti sandbagging clauses affect, they call it W&I insurance or R and W insurance?
Yeah. So I don't, if you're silent on sandbagging or there's pro sandbagging in the agreement, that doesn't really make much of a difference to us because we just don't allow sandbagging. You can't sandbag us. You can sandbag the seller all you want as the buyer, but we don't want to be sandbagged.
Yeah. Someone asking a question around more example of claims paid out in the past 12 months. I think we covered that, but maybe if you have a good story that you want to finish off with.
It's funny. I don't have a good. We've only been around 2 years. I don't have a great. I wish I had a better claim story, but I right now I don't. So we haven't paid a claim. I'm sure we'll pay one soon, but right now I don't have a good claim story.
Okay, so I mean that's interesting in itself. So you haven't seen just a ton of claims being kind of brought forward in your policy.
We have seen notices, but it does take some time. Usually there's kind of a tail period. Usually you get a notice within the first 12 to 18 months after the deal closes. So we've been in business for 2 years, so we have seen some claim notices. We just haven't necessarily made it to the point in which we're ready to pay them. So I'm sure we'd have, if you came back to me a year from now, I'm sure we'd have some stories, but right now I don't have anything I can.
Well, that's a good thing. Awesome. Well, hey, we're up against the hour. Dan, I mean, you've been an awesome guest. I always knew you were going to be, but this has been fantastic. I think it's, I love getting really granular on this stuff. And, I think you've answered a ton of questions for our audience here. So appreciate your time, everybody that's on today. As our audience here, I appreciate your guys' time too. This will be recorded and it'll be shared through the Divestopedia website. So again, Dan, thank you very much. And let me throw your email address here just one last time so everybody can have it. Dan, thanks again. You've been awesome. Everyone, super humbled and grateful that you're able to join us here for the hour.
John,
have a great day.
Thanks for having me, John.
Yeah, take care.
Take care.